Hi everyone, welcome to another episode of Global Market Perspectives. During this episode, we want to bring you some updates about global markets, the environment of risk, as well as what we have done during these months of volatility during the Trump tariffs, as well as some of the global developments that have affected markets. In short, global markets have since recovered from the sell-off in April, and the actions that we did during this period of time, such as opportunistic buying and selling, as well as implementing of protective hedges, has really added value during this period of time. And we're very happy with how things have turned out, and stick around if you want to dive into the details. So maybe just starting off with market updates in terms of how global stocks have done and how different country equity markets have behaved this year. And I think first off, looking at the chart, you'll be really surprised to see that at the top of the chart, or in terms of equity returns, you have countries like Colombia, Poland, Greece, as well as the Czech Republic leading the charts at returns above 40%. You have 50%, 40%, and 30 over percent. I think no one came into 2025 forecasting that these countries would be the best performing equity markets so far. And on the other hand, you can see the US, which has been a leader in equity market returns, really closer to the end of the table. So herein lies an important lesson for us, or important reminder for us, that global diversification is very important to ensure that investors capture returns anywhere it shows up in the world. And just a quick look at how markets have behaved in April during the recent sell-off, and we can see that from a peak to trough in US stocks, US markets went down almost a minus 20% after peaking on February 19. Conversely, international stocks held up much better all the way up to April before commencing a decline of about minus 13. So a global portfolio would have done well during this period of time because of the diversification outside of the US. And subsequently, from the bottom, both markets have done really well. International stocks in orange have rallied close to 19% during this period of time, and US stocks did very similar with a positive return of about 20%. So jumping ahead to risk update, I think one of the main things that we're watching during this period of time is a developing bear market, or a possibility of markets experiencing more weakness. So as you can see over here, I have something titled On Watch for Bear, and basically this indicator shows us a heightened risk environment when it activated on the 7th of April. So typically, whenever this indicator activates, historically, market experiences an average decline of about minus 20%. It is not a 100% indicator that tells us that we're going to a bear market, but this indicator just focuses us to watch for risk during this environment. I'm going to talk a little bit more about how we're going to respond to this indicator later on. And one of the key concerns that we have also been hearing from investors is a possibility of a global recession. So at the same time, we're also on watch for deterioration in global economic strength. However, at this time when we're looking at the hard data, really none of the indicators point towards a global recession that's already upon us, or at a level that we should really be concerned. As of the latest data update, you can see that global recession probability currently sits about a 12%. And really, this has been helped by the strength in China as well as the Eurozone in terms of economic resilience. So on the positive front, we had a really positive signal that activated on the 12th of May, and this is really our global market rally signal. So after the pause in tariffs between the US-China relations, after the 90-day pause, global markets experienced a relief rally, and global stocks have since done really well, as shown earlier in my market update. So on balance, how did we react to kind of these opposing signals during this period of time? So in April, what we did was that as we went into the April downturn, or the April correction, equities within portfolios declined and bonds and cash kind of stayed stable. So during this time, we took the opportunistic time to actually sell out of your stable assets, that means the bonds and cash, to rebalance into equities to buy it at lower prices. And that has really proved to be very timely, as we managed to reap the returns of the global market rally. And then secondly, during this period of time, we also took the opportunity to reduce equities as markets were recovering, and implement protection to the upside, such that we are positioned that if markets do decline, we'll be okay, because we have already took risk off the table. But at the same time, if markets do rally like it has, then we are also able to capture that with our protective hedges. And then the most recent action we did in May is to neutralize our equity underweight. So we have put back capital into markets, and we're now market weight. And currently we're looking for opportunistic windows to add protection within the portfolio to ensure that we're still focused on preserving capital within the portfolio while capturing returns. So really, the bottom line is that we're watching the data, we're watching for economic deterioration, and we're going to respond to data as it develops. And at this time, I think the bottom line is that there's really not too much to be worried about. You should be safely assured that we are watching the risk, we're responding to the risk, and we're capturing returns anywhere it shows up in the world while still protecting your capital. So I hope this update has been useful for you, and as always, we are committed to growing your capital while protecting it, and I'll see you next time.